When you look at the checkout page of almost any major online retailer today, you'll definitely see that specific shade of Bondi mint green sitting right there beneath everything. The proposition is simple. You divide the cost of your purchase by 4, you pay the first installment today, and you get your item immediately. For millions of shoppers around the world, clicking that green button feels like a highly responsible budgeting decision. It feels like you're taking control of your personal cash flow while still getting exactly what you want right now. You buy a $200 pair of shoes, you pay $50 today, and the shoes arrive on your doorstep the next morning. On a purely mathematical level, this equation makes absolutely zero sense for the company offering the service. They're handing out money to millions of young, statistically risky consumers without charging them a single cent in interest. Traditional finance dictates that if you take on the risk of lending money, you must charge interest to protect your downside. Yet, this exact interest-free model created an absolute frenzy in the global financial markets. This simple payment application exploded in value, becoming a tech unicorn that suddenly dwarfed national airlines, major supermarket chains, and the physical telecommunications infrastructure of an entire country. So, how does this happen? How does a company build an empire worth tens of billions of dollars by offering a service that appears to be completely free for the consumer to use? Back in the early 2010s, millennials entered the consumer economy carrying a deep suspicion of the traditional banking system. They'd spent their formative years watching the 2008 global financial crisis devastate the international economy. Through a constant stream of news coverage, they saw global headlines dominated by mass foreclosures and realized exactly how fast high-interest credit card debt could shatter a family's financial stability. Watching that unfold left an entire demographic with a structural aversion to traditional credit. By the early 2010s, the market data was undeniable. Young people were flat out refusing to apply for credit cards. They stuck to debit cards, only wanting to spend the cash they actually had, and they were completely terrified of compound interest. That deep terror of debt makes perfect sense when you realize financial anxiety is one of the heaviest burdens a person can carry. While researching these corporate disasters, we see how quickly people crumble when their financial stability evaporates. There's often a massive amount of quiet shame attached to financial pressure, which makes reaching out and actually asking for help the hardest hurdle to overcome. You get caught in a cycle of mental fatigue, trying to shoulder the entire burden in secret, making the prospect of admitting you need support feel incredibly intimidating. I remember a period when viewership dipped unexpectedly, but the expenses of running the channels and paying the team still had to be covered. I had to slowly drain my personal savings just to keep the business afloat, and thankfully the numbers eventually recovered, but the looming reality that I was just weeks away from being forced into heavy debt was paralyzing. You're quietly calculating exactly how long your safety net will last, and carrying that stress entirely alone is exhausting. This is where our paid partner for this video, BetterHelp, comes in. Admitting you need outside help takes massive mental energy, and the last thing you want to face right after making that choice is a logistical nightmare. Trying to find a professional on your own often means spending weeks researching options just to figure out who has the right expertise. That friction alone is enough to stop people from getting support. BetterHelp removes that overwhelming hurdle and makes it incredibly easy for you to start therapy. You just take a brief quiz to get quickly matched with a credentialed therapist who understands your situation, and once matched, the process adapts entirely to your schedule. You can communicate however you feel most comfortable, whether that's through a video call, a regular phone call, or even via text. The sheer volume of everyday responsibilities can easily mask how much mental weight you're actually carrying. You might be juggling family commitments, maintaining a social life, and keeping up with endless life admin, only to realize you need a professional to help untangle your thoughts. Life rarely sticks to a neat routine, so having a service that actually flexes around that chaos gives me massive relief. Being able to take a session over the phone while sitting in the car or going for a walk ensures therapy doesn't become just another stressful chore on your to-do list. So what are you waiting for? Take control of your mental well-being. Click the link in the description or go to betterhelp.com/infiniteltd and get 10% off your first month of therapy today. Now, back to the video. Debt as a word was tainted, something associated with people who were in financial trouble. However, this created a massive friction point in the broader economy. Even though this generation hated debt, they still wanted to participate in the consumer economy. They still wanted to buy clothes, electronics, and cosmetics, and they were highly engaged online shoppers. But their spending power was strictly limited by whatever cash they had sitting in their checking accounts on any given day. In 2014, a 24-year-old entrepreneur named Nick Molnar watched this exact generational anxiety play out in real time. He was running an online jewelry and watch business out of his bedroom in Sydney, trying to move physical inventory through a digital storefront. As he spent hours poring over his website analytics, he kept hitting a massive, frustrating bottleneck. His customers were consistently abandoning their shopping carts at the very last second. He could see the exact user behavior mapped out on his screen. Young shoppers would visit his site, spend time picking out expensive accessories, and load up their digital carts. They clearly wanted the products, but the moment they reached the final checkout page and saw the total upfront cost, they would simply close the window. The psychological friction of parting with hundreds of dollars in a single transaction was an absolute conversion killer. The desire to buy was there, but the financial mechanism to comfortably complete the purchase was entirely missing. Molnar ended up discussing this metric with his neighbor, Anthony Eisen, and the dynamic between the two created a perfect partnership. Molnar was a young e-commerce operator who deeply understood millennial consumer habits and digital marketing. Eisen was an older, highly experienced former chief investment officer who understood the complex plumbing of the banking sector. They lived across the street from each other in the affluent Sydney suburb of Rose Bay, and their casual conversations quickly turned toward Molnar's cart abandonment problem. When they sat down and looked at the data together, they realized this was a structural issue with the economy itself. They were looking at $1 billion behavioral roadblock affecting the entire retail industry. The solution required a completely new financial mechanic. They realized that if they could figure out a way to remove the painful friction of the upfront cost and do it without triggering the millennial terror of traditional credit cards, they could unlock a massive, untapped wave of consumer spending. Their solution to the cart abandonment problem was the pay in 4 model. It's a masterpiece of retail psychology because it operates on absolute simplicity. A customer buys an item but pays only 25% of the total cost at checkout screen. The payment platform pays the retailer the full amount immediately, absorbing the entire financial risk of the transaction. The customer then pays the remaining 3 installments over the next 6 weeks, and if the customer makes all their scheduled payments on time, the service costs them absolutely nothing. The brilliance of this system relies on shifting the primary cost of credit away from the consumer and dropping it entirely on the retailer. Retailers are charged a fixed transaction fee, usually around 30 cents, plus a percentage of the total sale, which typically hovers between 4 and 6%. For a clothing brand or an electronics store operating on tight margins, giving up 6% of a sale is a massive financial hit. It's significantly higher than the standard processing fees charged by Visa or MasterCard, but retailers were incredibly willing to pay that premium because the platform guaranteed a massive, immediate increase in sales volume. When customers feel like they're only spending a fraction of the price today, their purchasing behavior changes entirely. The average order value spikes, and shoppers buy 2 shirts instead of 1. They add the expensive shoes to the cart because the immediate upfront cost is diluted over a month and a half, making customers feel like they've unlocked free money. At the same time, retailers watched their conversion rates multiply. Molnar and Eisen had effectively invented a completely new category of consumer finance that bypassed traditional banking entirely. After registering the business as Afterpay in 2014, the platform's adoption rate among online boutiques became so aggressive that the founders immediately needed massive amounts of capital just to fund the endless flow of retail transactions. To feed that hypergrowth, they went straight to the public markets, listing the company on the Australian Securities Exchange by May 2016 and raising $25 million in their initial public offering. They had successfully built the financial engine and proved the mathematics worked at scale. However, having a functional product is very different from achieving cultural dominance. They still needed a way to convince a fiercely debt-averse generation to actively download the app, trust the brand, and integrate it into their daily lives. The mechanical structure of the 4 payments was only the baseline infrastructure. To actually achieve total market dominance, Afterpay had to pull off a massive psychological rebranding of debt itself. They needed to make owing money feel safe, modern, and even aspirational. Traditional banks sell credit through a lens of anxiety and legal obligation. Applying for a standard credit card involves stark paperwork filled with intimidating terms like annual percentage rate, minimum monthly repayment, and default notice. Afterpay threw all that traditional finance terminology out the window. They brought in top-tier digital designers to build an application that functioned less like a banking portal and more like a curated shopping feed. The interface relied heavily on a soothing pastel mint green color palette, and the language used throughout the platform was relentlessly positive and affirming. Management made a deliberate strategic decision to position the product entirely as a budgeting tool. The words loan and debt never appeared in their consumer-facing marketing. By visually dividing a $200 purchase into 4 $50 payments right on the checkout screen, the application anchored the user's brain to the smaller number. The immediate dopamine hit of acquiring a physical item easily overpowered the abstract future obligation of paying for it. This psychological shift was then amplified by a highly aggressive influencer marketing strategy. Throughout 2018 and 2019, platforms like Instagram and YouTube were flooded with lifestyle creators filming massive clothing hauls. These influencers would unpack thousands of dollars worth of fast fashion and explicitly tell their young, highly impressionable followers that they funded the entire shopping spree using Afterpay. The company went beyond digital ads and successfully invented its own retail holiday. They launched Afterpay Day, a massive biannual sales event that routinely generated mainstream news headlines and drove millions of dollars in transactions within a single 48-hour window.
Well, if you love a good bargain buy, and who doesn't, you are in for a real treat. Afterpay Day officially kicking off today with huge markdowns in major brands. By
2020, their cultural cachet peaked when they secured the title sponsorship for Australian Fashion Week, completely cementing their status as a premium lifestyle brand rather than a lending institution. This brilliant branding strategy effectively masked the underlying financial reality. Millions of shoppers were taking out short-term, unsecured loans to buy depreciating consumer goods. Because the payments were spread out and carried no immediate interest fees, users felt completely justified in running multiple orders simultaneously. A single user might owe $20 a week for a dress, $15 a week for a pair of sneakers, and $30 a week for a skincare routine, slowly building a mountain of hidden liabilities. While the application presents itself as a simple budgeting tool, the underlying corporate structure operates as a highly efficient financial system. Reaching a multi-billion-dollar valuation required more than just pastel branding. The core revenue stream of this business relies almost entirely on merchant fees. Taking a percentage of a sale is the exact same strategy traditional credit card companies like Visa and MasterCard have used for decades. The major differentiator for Afterpay is a highly accelerated financial process called capital recycling. Traditional retail banks generate profit by holding cash and earning the difference in interest between what they charge borrowers and what they pay depositors. This is a very slow process, and most retail banks make a net interest margin of roughly 2% over the course of an entire year. Afterpay achieves that exact same margin in just 6 weeks. The terms of service require customers to repay their total balance over 42 days. When a customer spends $100, Afterpay collects its gross profit from the retailer upfront. They take that exact same capital and immediately redeploy it to fund the next user's transaction. If a consumer uses the service 10 times a year, the initial $100 is recycled repeatedly. This rapid turnover converts a small, single-digit transaction fee into an annual return on capital that vastly exceeds 20%. Because this money moves so quickly, the company doesn't need to hold massive cash reserves. They borrow capital from Tier 1 institutional lenders at incredibly low wholesale interest rates. They then lend those funds to consumers without charging interest, and then use the continuous influx of merchant fees to cover their initial borrowing costs. Those merchant fees also absorb the inevitable bad debts from users who fail to make their repayments. This entire financial model relies on two specific macroeconomic conditions remaining constant. Wholesale interest rates need to sit near zero, and consumer retail spending must remain extremely high. When institutional investors analyze the sheer volume of these daily transactions, they recognized the true nature of the business. Afterpay operated exactly like a high-frequency trading platform built entirely around everyday retail goods. As the user base exploded into the millions, the traditional banking sector began to panic. Major retail banks were bleeding highly lucrative credit card transaction fees, prompting them to aggressively lobby the government for immediate intervention. This corporate backlash ignited a fierce, multi-year debate across the financial press over exactly how the buy now, pay later industry should be classified under the law. Under the National Consumer Credit Protection Act of 2009, in general, a person cannot engage in a credit activity if the person doesn't hold an Australian credit license. This license requires lenders to adhere to strict responsible lending obligations, and they must perform comprehensive background checks, verify customer income, and ensure the borrower can actually afford to repay the loan without experiencing significant financial hardship. This regulatory process is expensive, highly time-consuming, and injects massive friction directly into the checkout experience. Forcing a customer to upload a payslip just to buy a pair of jeans would instantly trigger the exact cart abandonment problem the founders built their entire company to solve. Afterpay managed to completely sidestep this legislation though. They brought in high-powered legal teams who successfully argued a technicality. Because Afterpay didn't charge interest, and because they offered short-term credit that was required to be repaid in less than 62 days, they were technically exempt from the National Credit Code. They positioned themselves legally as a payment processing technology platform rather than a traditional credit provider. This legal distinction is the exact reason the company was able to scale so rapidly. While traditional credit card companies had to verify incomes, check credit scores, and endure strict regulatory compliance audits, Afterpay could approve a new user in seconds based on a highly secretive internal algorithm. They effectively operated a massive, nationwide lending operation inside a complete regulatory vacuum. Reports began to highlight the dangers of this loophole, and they published detailed casework showing that these new microdebts were causing extreme financial hardship in the exact same manner as traditional credit cards. If a user misses a scheduled payment, their account is immediately frozen and they're hit with a late fee. Afterpay charged an initial $10 late fee, and if the payment wasn't made within 7 days, they charged an additional $7 fee. The company, in this ABC article, defended this model, arguing that customers cannot continue to use the system if they are overdue on any payment, which, by their logic, prevents customers from falling into the type of endless debt spiral associated with credit cards. They pointed out that the vast majority of their transactions incurred no late fees at all. Consumer advocacy group and financial counselors strongly disagreed with this assessment. They reported seeing a massive influx of young people seeking urgent financial help because their bank accounts were being completely drained by automatic Afterpay deductions. Users were prioritizing their Afterpay installments over essential living expenses just to keep their accounts active. A report from the Australian Securities and Investments Commission revealed that in the 2018 to 2019 financial year, missed payment fee revenue for the entire buy now, pay later sector totaled over $43 million. Despite these stark warnings from financial counselors, politicians were highly hesitant to regulate a homegrown tech company that was generating massive wealth for shareholders and driving incredibly high volumes of retail spending. The regulatory blind spot remained wide open, allowing the company to expand internationally into the United States and the United Kingdom. By early 2020, the business was growing steadily, but the global macroeconomic environment was about to create a situation that nobody could have predicted. Governments around the world forced millions of people into strict lockdowns, and physical retail stores shut down completely, accelerating a massive, permanent shift toward online shopping. Simultaneously, global central banks slashed interest rates to near zero to prevent a total economic collapse. This meant institutional investors suddenly had access to incredibly cheap money, and they were desperately looking for high-growth tech stocks to park their cash and generate returns. Afterpay was the exact perfect vehicle for this specific economic moment. Their user base in the US was exploding as young Americans received stimulus checks and spent them online. By December 2020, they had reached 8.1 million active customers in North America alone. The public stock market reacted to this user explosion with absolute euphoria. While the share price briefly crashed to roughly $8 during the initial pandemic panic in March 2020, it took less than 12 months for the stock to go completely parabolic. Fueled by a massive surge in online shopping and a flood of zero-interest capital, Afterpay hit an all-time high of over $158 per share. This astronomical run pushed the market capitalization of this single payment application to a staggering $39 billion, creating a scenario where the financial markets officially decided a 6-year-old startup providing short-term lay-by for clothes was worth considerably more than legacy corporations holding massive fleets of commercial aircraft and entire national supermarket supply chains. The growth was so rapid and the valuation so high that it created a severe case of fear of missing out among major financial institutions. Legacy payment companies like PayPal and Commonwealth Bank rushed to flag their intentions to launch their own exact clones of the Pay in 4 service. The entire global financial sector was forced to pivot their technology roadmaps just to defend their market share against this single Australian company. In the upper echelons of corporate finance, there's a well-known concept called the greater fool theory. It suggests that an investor can make massive amounts of money on an overvalued asset, providing they can find someone willing to pay an even higher price for it before the broader market realizes the true value and corrects itself. In August 2021, the founders of Afterpay found the ultimate buyer. Square, the massive American financial technology company led by Twitter co-founder Jack Dorsey, announced it was acquiring Afterpay. Square, which shortly after rebranded to the name Block, wanted to integrate Afterpay's massive global merchant base directly into its existing Cash App ecosystem. The strategic goal was to create a massive closed-loop financial network that could bypass traditional banks entirely, allowing users to discover items, buy them on installment, and transfer money all within the same application. Valued at roughly $39 billion, the transaction instantly became the largest corporate takeover in Australian commercial history. The deal minted Nick Molnar and Anthony Eisen as overnight billionaires just 7 years after they launched the company, allowing them to seamlessly transition into highly paid executive roles leading Block's merchant and consumer divisions. The actual mechanism behind this historic payout, however, was built entirely on paper wealth. Block structured the buyout as a strict all-stock deal, leveraging their own massively inflated tech shares as the sole currency to finalize the acquisition. The execution of this all-stock deal stands as one of the most perfectly timed corporate maneuvers of the decade, primarily because it was announced just weeks before the global economy fundamentally fractured. Throughout 2022, the combination of broken supply chains and massive pandemic stimulus packages triggered a wave of soaring global inflation. Central banks worldwide reacted by hiking interest rates at a pace unseen in decades. This sudden, high-interest environment was fundamentally toxic to the entire buy now, pay later business model. Since the platform relies entirely on borrowing capital at low wholesale rates to fund interest-free consumer loans, a spike in the cost of borrowing instantly crushes the profit margins generated by those merchant fees. Simultaneously, inflation triggered a severe cost of living crisis on the consumer side. Everyday shoppers watched their rent and grocery bills skyrocket, effectively wiping out their disposable income for discretionary online shopping. The volume of retail transactions began to drop, while the likelihood of users defaulting on their accumulated microdebts surged. As these dual economic threats materialized, the broader tech bubble violently collapsed. Because Block structured the buyout using their own stock as currency, the value of the Afterpay acquisition crashed in real time alongside Block's share price. By the time the deal officially closed and the paperwork was finalized on January 31st, 2022, the actual value of the transaction had evaporated from the headline $39 billion down to roughly $13.9 billion. Retail investors who held their shares waiting for the final payout saw their portfolios completely decimated. Financial analysts began publicly tearing apart the logic of the buyout, noting that Block had added roughly $12 billion of goodwill to its corporate balance sheet. That massive accounting figure relied entirely on the assumption that hyper-aggressive growth and zero-interest capital would last forever. With consumer spending tightening across the board, the market predicted Block would inevitably be forced to write down the acquisition by billions of dollars. The founders of the platform, however, had already secured their exit. They managed to read the absolute peak of the pandemic tech hype cycle and locked in their massive payout right before the market sobered up and started demanding actual profitability over raw user growth. That sudden financial sobriety eventually extended beyond Wall Street and directly into the halls of Parliament. The regulatory ghost that allowed the company to grow so fast had finally been caught. Following years of pressure from consumer advocates, the Australian government passed the Treasury Laws Amendment in 2024. This new legislation officially extends the National Credit Code to cover all buy now, pay later contracts. From June 2025 onwards, these providers are legally required to hold an Australian credit license. They must comply with strict responsible lending obligations, forcing them to actually check if consumers can afford the debts they're taking on before they approve a transaction. The era of frictionless, unregulated microdebt is officially coming to an end. There's absolutely no denying that this platform completely revolutionized the global retail sector. They forced sluggish, complacent legacy banks to modernize their approach to consumer finance and digital user experience. They built an incredibly popular product that millions of people use responsibly every single day to manage their cash flow without paying interest. However, they also built a system explicitly engineered to exploit behavioral psychology. They masked the harsh reality of consumer debt behind pastel branding, influencer marketing, and frictionless user interfaces. They normalized the habit of buying things you can't immediately afford and shifted the severe financial risk onto a generation that was already struggling with rising living costs and economic uncertainty. But what do you think? Did this platform actually democratize finance and give consumers a vastly superior alternative to the predatory credit card industry? Or did they just build a highly polished, culturally relevant debt trap for the Instagram generation? Let us know your thoughts in the comments below. And if you want us to keep pulling apart the exact mechanics of modern business, hit the like button, subscribe, and hit that notification bell so you never miss our next deep dive. Anyways guys, thank you so much for watching, and as always, stay curious.